All righty. Good evening, everyone. Welcome to the Hurley Investments Market View commentary for April the 8th. Glad to be here with you today. We're going to start this one off reviewing what we went over last Thursday, just a little bit, partially because the recording was jumbled and partially because we usually have different people attending different webinars. Let's just make it pretty simple to call it what it is. Some of you like to attend the trade findings and adjustments. Some of you do not. But I will be the first one to tell you, I am excited that we're going to be taking a profit on April 19th on Meta. This is a couple days old. We took this last Thursday morning. But I just want to go over my thought process on Meta really quickly so you guys can have an idea why I'm so excited to get out of it. We've got some short calls in play. And I'm going to go over this one more time. We are obligated to sell our stock at $500. We are going to get a credit of $9.10. So if you're looking at our stock being sold, our stock is being sold for roughly $509.10. Some of you have said, well, Kevin, the stock right now is trading at $5.1925. That's where it closed. Yes, we understand that. And I will work on what we're doing to take care of that. But in this particular account, we have 500 shares. They actually tell us the cost basis is $140,740. But what they don't understand is we bought 300 shares, 100% paid for with put profits. The real cost basis on this is closer to somewhere between 78 to maybe on the high end 90,000. But for the most part, the stock costs 78. We probably added a couple sets of long puts where we didn't make everything on them. Some of them we made great money on them. I'm going to go on the high side. Our real cost basis is around $90,000. That means of this cost, it says 140, 50 of it you've already paid taxes on. 50 of it, if you had 500 shares of Meta, taxes have already been paid on it. The value was $257,200. If we're getting called away or we're going to take our profits at 500 shares, here is a $250,000 that we're going to get out right here. And we're going to add that extra credit of $4,554. We're basically getting out with $255,000. Of that, 160 is pure profit. We are booking a profit. And we're booking a profit because we've got a ton of money there. It's time to take it off the table. Meta truly is fully valued in that 550. You can make a case for it to be fully valued at 651, but we are past fully valued. At some point in time, you have to take your profit. You have to take your profit and then you find something else to go into. Now, someone already told me, well, Kevin, what if it keeps going up? We understand In this account, we put 3 contracts of 520 to 600. We have already paid $32 to try to make the next 80 between 520 and 600. We're going all the way out to January 17 of 2025. So if Meta keeps going farther, we're in good shape. But here is the question. Is it a good idea to book $261K or roughly $188,000 in profit and replace it with only a cost basis or a risk of $9,600? What do you think? And actually, I've got those numbers a little bit off because it's probably, well, 50, 90, 50. Yeah, that is pretty accurate. Never mind, I'm keeping it in place. What do you guys think? Does it make sense to take $261,000, book a profit, $188,000 of it, which is profit, which you're only going to be taxed on less than that, significantly less than that, going to be taxed on roughly 90-ish. Does it make sense to take that profit and replace $261,000 of risk with only $9,600? What do you guys think? I am looking for a comment or two. Jim Kohler says yes. Mary says yes. You can tell you guys have some Meta shares in here. How about some of you other guys? Does it make sense to take $261,000, turn it into cash, where you have somewhere between $170,000 to $188,000 of profit, and book it, replacing that $261,000 of risk? Because technically, Meta could go to zero. There could be a problem. $261,000 of risk off the table to replace it with $9,600. One of the points I want to tell you is, if you're not willing to book your profits, then to a certain degree, you have no place being in the market because you're gambling. You're letting it go up. Oh, it's going to get back to it. Oh, it's going to get back to it. And you're just getting jerked around. There has to come a time when you say, you know what? It's time to book those profits. It's time to take that money off the table. There's plenty of other things that we can be going into. Doesn't mean we're going to jump into it right away, but there are other positions to go into. We're also going to extend the Meta opportunity through a stock replacement strategy. We're not saying we're completely out of Meta, because yes, Meta could go up to 651. It could actually go up to 800 if you take some of the ridiculousness out of the market. And yes, we're still going to participate, but we're going to do it for, and if I go ahead and I take a look at the numbers here, instead of doing it for $261,000 of risk, 9,600 divided by 261,000, we're going to do it for 3.6% of our equity at risk. We're going to take off 96.4% of the risk on $261,000. We're going to take that off the table, and we're only going to put at risk 9,600. That is what we're looking to do. That is the importance of being willing to take a profit at some point in time. And I don't know about you, but I like playing with the house's money. I like having the opportunity to play with the house's money, to book a great profit and know we had one that we knocked it out of the park. There's plenty of others that are going to be knocking it out of the park. We're in some really good positions on some stock positions that should move pretty quickly going into this year. Some of them already have, but it just makes sense to take some of our risk off the table and to book that profit. Someone just asked, so some of you have, we actually have 5 sets of the stock replacement strategy: a 240 300, a 250 300, a 320 400. I think we have some 300 400s and some 480s 520s and 520s 600s. So we have a bunch. Actually, that's 6. We've got 6 stock replacement strategies there. For some of these that are deep in the money, we're looking to see them make 100% their maximum profit. So Russ, the question on the 240s, 300s, we've got about somewhere between $400 to $600 of profit still there. I would expect to see those get called away sometime after the next earnings. Why not take a max profit on those? At least that's what I'm trying to do in my account. I've got 3 out of the 6 as well, as it kept marching higher. By the way, Bosserman just gave me a compliment. This is what it's all about. I love that guy. Even though we haven't gone fishing yet, Bosserman's one of my favorites tonight. Taking a look at a couple of our positions. Apple sitting right at a support level. It's right at that 168. Kevin, how are you calling it a support level? Bounced off it here, bounced off it here. We're bouncing off of it right there. We held that 168 level today. Closed at 168.45. We're very close to getting puts back on Apple. As of right now, we're sitting and doing the best that we can. The short answer is we're going to figure it out. It's one that we're watching pretty close and making sure that we're ready to have puts in place. All right, we took our last puts off on Apple at 170, so we're only down $1.55 from where we took our puts off last time and booked a profit. Baidu, we've taken puts on and off a couple times. I really wish we would have been a little bit smarter, but we got Baidu puts on today at 104, probably going to go down to 97. Probably going to go down to 97 because the United States is over there talking. Well, Yellen's been over there talking with her this weekend. We also have Secretary of State and Biden that are supposed to be talking with China through this week. Baidu broke the 50-day simple moving average today, so puts went back on. Wouldn't surprise me to see it get back down to 97, maybe even 96. And then we typically see a bounce higher from there. Disney. We did really good putting puts on Disney, I believe up at 123. Why do we put puts on Disney at 123? It was overbought. We caught it nicely. Disney seems to be holding 117. It might come down to the 113, where we have 1, 2, 3 resistance levels. We also have a support level, a short-term S1 pivot point at 113. What a run we've seen on Disney. $80 in November, up to 117. I remember some of you were saying September, October, why are you in Disney? Well, I've got some really interesting Disney that I want to share with you, but it really comes down to their numbers still make sense. And because their numbers still make sense, we are still in Disney. If you were to ask me, Disney's next CEO is probably going to be Dana Walden. She makes sense. She is one of those that doesn't take any crap. She is one of those that should have moved into the position instead of Chapek's. She is one of those that makes the numbers work. Don't be surprised to see Disney's next CEO be Dana Walden, be a lady that's more than qualified to take this to the next level. Please read through this to know more about who I would say will most likely be the next CEO of Disney. Tons of information in here about her and what she does. Disney. Its money maker has always been the parks. The cash cow is the movies. But the short answer, a great article on Disney and the parks. I don't agree with some of the points because they make it sound completely dramatic. 3 years ago, I was standing in a park where it nearly stood empty. Even during the throes of COVID, Disney was never empty. It is ridiculously busy in Anaheim. It is ridiculously busy in Florida. This is something for you guys to read about what Disney is doing to position themselves to make a great return on the core of their business. Doesn't mean their movies can't make some great money, but the core of their business has been and always will be their theme parks. It is a ridiculous amount of money to get into Disney. They make it somewhat cheaper where if you'll be willing to spend what it costs for 3 days, then they'll only charge you 2.5 days, and it's ridiculously priced. Yet the parks are packed. Great thing to understand on Disney. Read through this article to see where their real money is from, and you'll see it's in their parks. Okay. Here we go. Big picture, not so interesting this week. Basically, they're going to make this comment. The big picture is saying, hey, you should spend more time understanding that there's probably going to be very few rate hikes with the low interest rate and the fact that the non-farm payroll came out as high as it did. Non-farm payroll has always been a very important understanding of how the economy is going. at over 300,000 jobs last week, you're not going to see a rate cut. In fact, I will go so far as to say our first rate cut will not be till after the election in November, possibly December. It doesn't warrant it. And we're also going to get CPI numbers this week. I'm going to go over those. Core CPI numbers come 2 weeks from now, and those also shouldn't be really good. So just before we have our rate hike meeting at the end of October, 1st of May, then yes, we're gonna have an opportunity to get some great numbers that will not warrant a rate cut. So the market's going to have to recalculate for that. They're going to have to recalculate for such a robust first quarter. Expect it to be a pretty good pullback in summer. Really looking to do puts and full collar trades for summer so that we're really protected on our positions as they're heading down, or most likely will head down. Last week, worst week since January for the Dow, worst week since October for the S&P. The Dow is now technically bearish and just trying to get above the 50-day simple moving average. A good example of what's happening to our market, looking at that chart, the stock market is rolling over. This is a rolling over, rounding type of stock market. The expectation, if things were to fall back, it would go down to the 3750 where we started, the S2 pivot point at 37,953, or it'll drop all the way down to the 200-day at 36,032, which means we should have a very robust end of the year. S&P bounced off of the 50-day median line. Still above. Remember we talked a couple weeks ago about it coming back. This is a great for the S&P, building a base. We'll probably do a week or two like this. In 2 weeks, we're going to start our earnings season again for the second quarter. Would not surprise me to see us go sideways for the next 2 weeks. That 50-day will grow closer to where the S&P is trading, and then we can see it bounce higher. Also, if it was to fall or drop, poor earnings, 49.83 would be our first stop on the way down. We probably would not hold the 50-day at 5,089. Doing some simple math, we'd lose about 3.5%. NASDAQ looks just like the S&P. Exactly the same thing. It's coming back to the 50-day. When you see these big bounces, when you see this big difference in between, it comes back. And all we're doing is coming back pretty close. Wouldn't surprise me to see things more or less going sideways for the next couple weeks before we start our earnings season here in about 2 weeks. All righty. Still think we'll be up 2% for April, just following the trend. Earnings, not much happens. WD-40 on Tuesday, Delta Airlines on Wednesday. It looks like CarMax and Fast on Thursday. BlackRock, JP Morgan, and Wells Fargo on Friday. This week, CPIs on Wednesday, FOMC minutes. Nothing in the minutes should surprise you other than they're data dependent. So not much to worry about in the minutes. PPIs on Thursday, Friday, Michigan sentiment. Here's our problem. We're still looking at CPIs and PPIs being up 0.3%. Inflation is showing that we're in that 2.9 to 3.4% range year over year. We probably are not getting back to 2%. So because of that, we need to be smart. We need to be smart and understand that some things are not going to happen like they used to. All right, let's see here. Letting some stocks run that are bullish, but with that said, we have Disney at 123. We have Square protected at, I don't know, I'm going to say 80. I don't really remember. Disney's protected at 123. I already did that one. Micron, we protected that at 123. Baidu is protected at 104. And I think that's where we're at for everything. Getting ready to get protection on Apple if it breaks that 168. And Under Armour is right there. It broke 7. We've made money from $9 down to $7.31. We are watching Under Armour and trying to decide if we're looking for a bounce higher or what our overall decision is going to be. So that's where we're at for Under Armour. Bank of America, I'm pretty sure we've got nothing on Bank of America right now. All righty. Yellen warns a China surplus of solar panels could be dumped on global markets. All that means is it's going to be cheaper for clean energy. It means U.S. companies won't make as much, but the world will get a huge amount of clean energy, solar panels, batteries, and so forth to save money. I don't know why they're crying so much about it. All right. Interesting. And boy, I wish I had that article, but Jim Cramer says AI buzz is far from over. In fact, the game is yet to start. Do you know there's an anti-Jim Cramer index that whatever he says to buy, you do puts on, and it's making money and far outpacing and beating the S&P 500? I just found some interesting article that a lot of people are talking about the fear of AI and how much it can run. When it's in something, when it's in euphoria, AI can still move farther. It would not surprise me to see it continuing to go higher. So I hate to agree with Jim Cramer, but there's probably more AI opportunities to run. Fed's Kashkari, excuse me, brings to light that there is a zero prospect of rate hikes this year. We went from 6, and I was telling you maybe 3. It doesn't want to affect the elections. Our economy is running smooth right now. Interesting article that someone else seems to agree with me on the rate hikes and how few we may have. I found this very interesting. This was given to me by someone else in where those job growth occurred. It is slanted to make the Democrats look bad. It doesn't make a lot of sense on certain areas, but here's the short answer. There are more jobs going to our workers that are coming in that are non-US born workers. That is not a bad thing. They try to make the impression that, hey, it's actually illegals. Well, in all reality, Most illegals are not being reported as taking jobs. They just aren't. That's not how the system works. And there's nothing wrong. We do 2.5 million legal immigrants in the United States every year. If half of them are working, nothing wrong with that. That's perfect. It's slanted and it's not exactly accurate, but the short answer is there's growth in certain areas that again justify no need for a rate hike. There's the Disney one, and I think that's it. Okay, I guess I don't have too much to say today. Any questions you guys have that I can answer for you? Yeah, so stocks that I think have a room to grow. I'll just kind of go down the list. Apple can run from 168 back up to 199. Baidu from 103 at least up to 160, if not to 200 this year. Disney moving from 117.35 up to 165, if not 200. Google L sitting at 154.85 can probably get to 200 this year. JP Morgan at 198, it's really fully valued. So JP Morgan might be hard, but there is a stretch that you can make for it to get to 220. Lockheed Martin, 452, it can get back up to 582. Meta, fully valued right now. On the high end of the full valuation at 555, you can make and stretch it to 651. MRO, fully valued at 29.49, but you can make a stretch to previous highs up to 32 and or $35. Micron at 122, between 131 and 139, it's fully valued. And announcements on money from chips, it can easily go to 160. Square, $78, 110 back to previous highs. Under Armour, $6.80 today, can easily get back up to 9. Fully valued, it runs closer to $25. That is probably too high this year, but if we could get a little bit of running behind it, $16 is a very typical or standard run rate for Under Armour to get up to this year. Verizon sits at 41.73, full valued at 50, and I don't think it's going to get there. So just some thought processes to think about in regards to what stocks can still run for us. Those are the majority of them. Disney puts some are at 120. In fact, they all might be at 120. I thought we got them sooner than that, though. They're profitable. Our Disney puts are at 120 and profitable. Should that stay? Yes, we're watching Disney right now. We would love to see a bounce, but the true stopping point would be 113 Disney. At 113, we'll take a look at taking off the puts for profits or rolling them out in time for earnings or seeing if it gets down to the 50-day at 110. So we're still keeping those on at this time. Again, markets are rolling over, so we're not super positive that certain stocks will outbeat the market in general. Great question, Russ. Are there any other questions you guys have? If there are no other questions, appreciate you guys being here tonight. Keith will take over on Thursday again for us. Glad you guys are here. We're going to call tonight. Well, I'll make sure that this gets posted sometime tomorrow with Dave. Trying to stretch this out to see if any other questions come up. Doesn't look like any other questions are being typed in at this time. Guys, have an excellent evening, and I look forward to seeing you guys next Monday. Have a good evening, everyone. Bye-bye.